So I might be a fresh voice in that regard. Hey, what's up, Brandon? Um, don't be harsh. Judge me, but don't be too harsh, Brandon. But welcome. And I might be a new voice for some of you. I'm relatively new-ish to Wealth Builders HQ. It's been a happy welcome. It's been fun, and you know, to me, trading is a journey, and it's fun that we can, share the journeys that we've had, and also have new journeys with new people, new traders. So it's a kick in the pants for me. And so in this session, in the next hour or so, I'm gonna do a little talk track. We'll talk about a trade we did this week. We'll have a little lesson about just some exposure of what spreads are, and any other questions or never mind. You see the screens. Okay, looks like everybody can see the screen. So we'll take it in directions that you'd like to. So sometimes people need exposure to spreads in general. And so maybe before we get too deep into this, maybe we could do a survey real quick. So I have two questions. The first question would be, how many of you have never traded an option before? How about that? And maybe I have three questions. How many of you have never traded options? Let's ask that question. How many of you have done options, but only like single leg, maybe sold a single leg option or bought an option? And then third question is, how many of you have done spreads? So all these questions I'm coming up with before we get started here. Talk to me. So what's the consensus of the room? So Brenda and Jim have only done single leg. What about the rest of the room? Not spreads. Okay. So hopefully you'll find today's sessions informative, because I'll kind of break down a little bit of the nuts and bolts, what spreads are. And I can also sprinkle in on what I'm doing in my Vega Spread Mastery weekly sessions that I'm doing. Okay, and I find that I see your comment, Brenda. Brenda's making a comment about she's tried spreads a couple times, not too fond of them. And sometimes my feedback over the years, and I've been, by the way, I'll give you my bio in just a moment here, but I've been doing this a long time, half my life at this point. And sometimes people don't get into spreads because they think that there's too many moving pieces, or sometimes people don't want to sacrifice the profitability on an option. So they want to do a single leg because they're like, well, Sean, I'm looking for, big profits. And if I do a spread, it's kind of sacrificing some of my gains. And usually if you get to know that person over time, they've never spent the time to actually learn spreads. One of my good friends is an ex-Chicago options pit trader, and in Chicago on the exchange, and he handled orders for he handled orders for Goldman Sachs, and he was on the SPX desk. So he took on option trades for the SPX for institutional clients. So it's kind of fun to have friends that have done interesting things. And the comment that I got, and again, this is word of mouth, that Goldman Sachs, anytime Goldman Sachs brought them an option trade on SPX, it was never debit, it was always a spread, and it was always credit. Okay, so we're going to have a little conversation about spreads or what does it mean to do credit trading. And hopefully we'll have some fun today. Okay, so any questions before we get the ball rolling from the room? Nothing? Nothing? Okay, excellent. So this is me. You can see my shining face here. And yeah, I am a redhead. If you didn't notice that, yes, I have red hair, and Brandon can make all the jokes he wants. All right, so as far as Wealth Builders and Freedom Management, we are an education company, and we need to remind people of that. I always like to share. I could share the coolest things, the coolest stuff, but it doesn't matter anyway if you don't have proper money management or risk management. Trading success equals a viable strategy plus proper risk management. Okay. I gave you a softball, huh, Brandon? But yeah, in all seriousness, we need to manage our risks, right? And oftentimes that's why I enjoy credit spread trading, because oftentimes it's defined risk when we're getting into the trade. We kind of define our terms as we get into the transaction. Okay, so I have a slide example of a spread. I also have a trade we did on the 12th this week that I can share as well. And we'll talk about what that looks like as far as an exposure on risk. And again, it's a defined risk as we enter the trade. Okay. So a couple things coming up just as far as me, obviously they've been kind enough to have me participate in the inner circle sessions. That's been pretty cool. And looks like, we're doing that monthly on the 21st and the 26th. And it's been fun. The past 2 times I've jumped into inner circle, it's been more of just a group chat, just a tableside chat. And it's fun. I mean, because I've been doing this, gosh, for over 20 years at this point, half my life. And, people enjoy just, picking my brain. If I just sit here quietly and just let the questions roll in, I've done enough roles in this industry that I have a lot of hats, and there's not a whole lot of areas that I haven't touched in. So it's kind of fun. And so that's kind of what that's all about. There's a mastermind group coming up on June 20th. We have SPX Cash Flow Secrets as well on June 26th, and Trading You on the 28th. Power Hour, it's kind of a fun to jump into those as well. And obviously we're doing the Coaches Playbook. Okay. And so where can you catch me? I've been jumping into Inner Circle lately. Obviously we're doing the Coaches Playbook, and then my weekly Vegas spread mastery. And this I'm doing on Mondays and Tuesdays and Fridays. So I'm doing it 3 days a week, and we're doing it live. And it's just, let's pull up our sleeves and look at spread trading. And it's dominantly focused on weekly income for, weekly income on equities and spread trading. Okay. And what that looks like. And we get into a little bit of debit. Dominantly, it's more credit spreading, but we get into a little bit of debit. We get into a little bit of single leg, just as the market dictates. Sometimes we'll look at single leg stuff as well. Sometimes there's a ticker that has a little bit lower volatility, and so we still want to mess with it, and it's in a good zone. We might do, a debit trade, or we might sell a cash secured put because we might not mind having the shares put to us. Okay, but dominantly it's more catered towards spread trading. But we sprinkle in a little debit, and we sprinkle in a little cash secured single leg stuff as well. Okay. Cool. And so obviously you can follow us here on the various outlets, right? And so this is me, again, my shining face. I keep coming up again. And, it says join Sean Reed's Vega Mastery Spread. And to me, it's more nuts and bolts. How do we pull up our sleeves? And for one, how do we become a spread trader? And then all the nuances that come with it, and, good and bad. And, sometimes people need not only a nudge, but they need kind of a, how do we say this? A co-pilot. That might be a good word, or expression, to where, Sean, my spread is doing this, or Sean, my spread is doing that. Or what do we do here? Or what does this look like for you? And just in today's session, I just finished a session earlier today, and there was probably, I want to say, at least 6 tickers that I didn't bring up, that the students independently brought up, and we did, a group chat on what it looks like. And we're looking at things like the volatility of the ticker. We're looking at the trend of the ticker. We're looking at, where it is on the price chart, and then we're going over to the option chain, and we're looking and seeing if there's enough meat on the bone, or enough yield to actually jump into the trade. And so I guess it's a good word is holistic. So we try to cover, stem to stern in regards to day in the life of spread trading on equities, and more of like a swing trade style. Okay, so that's kind of what the mastery spread is all about in our weekly sessions. Okay. Any quick questions before we keep cruising? Any quick questions before I continue on my journey? And the weekly sessions are recorded, if I didn't mention that, to where you can pause, rewind, and to be honest, usually feedback that I've gotten over the years is that students sometimes prefer the recording of me because they can press pause, rewind 4 times till you grasp a concept. And there's no shame in that. It's all for the sake of learning and building. Okay. All right. So there's no questions coming in. So let's keep cruising here. All right. And so this is me, just as a footnote. I've done a lot of things, and I could try to put myself on a pedestal, but that's not my mission. I've been, active trading since 2001, and I've done industry stuff, but then I've also done, kind of on the academic side as well, education stuff as well. And so I'm kind of one of these that did more industry. So I guess I'm more practical rather than just, academic, if that makes any sense. And so for me, my journey was I was a firm capital proprietary trader, and 20 to 1 leverage on equities. I had licensure, so I could get 20 to 1 leverage on equities. So I was on a prop trading floor, and I did that for a number of years. They tapped me on the shoulder, said, "We like what we do, kid. Like what you do, kid. Will you move to Scottsdale and run a trading floor?" So I had 25 guys and gals underneath me. We were a licensed trading floor. So I was offering 20 to 1 leverage on equities for my traders. Fast times and Ridgemont High, and I was still in my 20s. And I kind of got burned out on that. My traders made money, we made money, but just the stress load, once you start making certain dollar amounts, I don't need to quote dollar amounts, but there comes personality or the affectionate prima donnas. And so I was looking for, to do another venue, and I walked over to Schwab, and they didn't know what to do with me because I was still in my 20s and I had done far more greater things than a lot of their senior brokers. Needless to say, they threw me on the fanciest team at Schwab, and I was in my 20s. I was on the Platinum or Pinnacle team, senior broker with Schwab. Fun experience, and I got to deal with the high net worth clients, and I got to deal with the active traders. And the biggest account that I got to play with, very often was a $14 billion account, and supposedly it was his play account, and it was some sort of Saudi Arabian prince. It was oil money. But each trade was $30 to $60 million that I was transacting for him. Super stressful, but it was fun. And I can say I've done it. And so that was fun experience, doing that. And towards the latter part, I was on the institutional side. So working with advisors, helping them with their practice. So needless to say, I became an advisor, then ended up running advisors. And I guess I was a district manager, if you will. I had a fancy title, but I was a district manager over 8 states and 150 financial advisors. So I'm kind of this weird guy where I have like the capital preservation advisory side. I also have the fast-paced day trading side as well. So I guess I'm a chameleon, a mixed bag of industry experience. And dominantly, I enjoy, my personal trading. I still enjoy trading equities more so in my like retirement accounts. Sometimes I do equities for weekly accounts as well, or weekly income. I also enjoy futures and options on top of futures. I've been doing that for years. So that's kind of my story. And I started as a fast-paced equity trader, transitioned into options, and then transitioned into, I guess, options first, then futures, then options. And now I mash everything together. Sounds confusing, but I do options on top of equities and ETFs. I do options on top of futures. And depending on the account that I'm working with, depending on if it's a retirement or weekly income or slower paced, like retirement style trading. And usually I do a pretty good job of prefacing when I'm in my weekly sessions, if this is a kind of a long-term savings account or wealth bucket trade, or if this is a fast-paced kind of weekly income trade. Okay. So any quick questions about the things I've done or the background that I've had? And from an educational standpoint, I've been teaching people to do this for conservatively 10 years, at least. And I've probably mentored thousands of traders. Well, I have mentored thousands of traders at this point. Any comments or questions before we keep going? And it's important for me to always remind myself not to be the tallest guy in the room. That's not my mission. My mission usually is to remind myself what it was like when I was first learning. And so that makes it much of an a better experience for all of you, but it also, kind of keeps it relatable, if that makes any sense. Could I talk at a very high level, talk over everybody's head? But what's the point? If you can't grasp what I'm trying to share, what's the point of me sounding fancy? So I guess the feedback I've gotten over the years is just I kind of break things down to their simplest components. Take a complicated subject and strip it down and make it pretty simple. And that's kind of my mission. Okay. All right, looks like we're good here, and let's keep cruising. And so if we were to begin, thank you for that, Jennifer. Yeah, Jennifer made a comment about just I'm relatable and not intimidating, even though I'm a redhead. I don't know, are redheads intimidating? I don't know. Don't answer that question. Don't answer that, Brandon. um, yeah, to me, it's just important that we all I don't know, it sounds corny or cliche, but it's like no man or no woman left behind, to know that we're all on this journey together and we all should, work together so that we're successful. That's my mission. Anyway. So if we were to talk about, just take a big picture, deep breath, right? And I saw some of you type in the chat that you're not necessarily new to options. Maybe there's some people that didn't, there's a bunch of you that didn't respond. Maybe you're completely brand new to options, which is fine. But to me, a bunch of you typed in, like 5 or 6 of you said that you do single leg stuff and you're kind of hesitant in regards to spreads, which is fine. And I think 1 or 2 of you said you do light spread trading. Okay, so I guess the bulk of my trading is spreads. And, more close to home, I'm working with my 24-year-old nephew, which is a kick in the pants. Him and I've been helping him with his, trading for probably 5 years. Last year, he kind of mastered single leg. And this year, over Christmas break, he was at my house, staying at my house. And, we pushed him to become a spread trader. And, I've been helping him. And anytime he has a question, he's usually pinging me at least a couple times a week in regards to his spread trading. So it's kind of close to the chest. It's kind of fun to work with him and see his evolution. And I have 2 boys. I have a 9 and 12-year-old, 2 boys, and same thing with those 2. It's just, I did my 12-year. We did some trading with my 12-year-old, and I'm just getting him started and teaching him options, which is a kick in the pants. Like, to me, it's like, why take kids through my personal journey? Why not just start them at my destination? And the destination is options trading, and I'll be an options trader till, I can't speak anymore or even think anymore, right? Or maybe I'm below ground. Maybe that's what I'm trying to say. So with all that said, it's a journey. That's my point. Sharing about my nephew or my kids, it's a journey, and there has to be some motivation, and you have to see some light at the end of the tunnel. Now, I can drop some seeds in our session today, but then again, it has to fit with you, and it has to fit in your business model. And so maybe today I should share not only what spreads are, but I should share why they fit in my journey. You know what I mean? I don't need to sales pitch you on spreads. It's more just exposure. And I guess what I could do is share why they fit. Why is it a good fit for me? Okay, maybe that's fair. So up on the screen, you can see is a little, kind of chicken scratch. And don't judge me on my high-tech graphics here. But I think this is valuable. And usually I share this to where people, I'll get there in just a second, Brenda, to where people struggle with spreads, and just as the concept. So when I've been working with students in the past, if I just draw this cheesy little drawing on a napkin, a piece of paper, or scratch paper, all of a sudden you see the light bulb go on. Okay. And so let's just start on the bottom one here. And so what if we've determined that our ticker is something that we may not mind? Let's back up. The ticker is dropping into some sort of level, and we could call it support. We could call it a buying area. We could call it a demand area, depending on your school of thought. So prices dipped, and we identify an area where we may enjoy as well, or on the chart, we think it may have a chance of holding the level, as we like to say. And so what could you do as a trader? Well, if you sell a put option, so forget the offset just for a second. So this says anchor. And as a side note, what's fun to remind yourself is the anchor would be your money maker in this case. Okay, so hold on to that for just a second. And if we were to sell a put here, we'd be selling a put on a ticker that normally, if this were single leg, what they say a single leg option, if you sell a put, shares could be put on you. Okay. You're basically reserving the right or selling someone else the right to put shares to you, if that makes any sense, or put shares on you. Okay. And so if you were to not do a spread, could you be a person that sells puts on a ticker you may not mind owning? Okay. And so if you sell puts, okay, what they call a covered put or a cash secured put, in this case, you would need $35 times 100. So each option contract represents 100 shares. So in this case, you'd need, $3,500 in the account to sell a single leg put on the account. And by the way, you're saying that if at expiration at the end of the option journey, it finishes below 35, they could end up putting the shares on me. But you may not care because you may not care because you may not mind owning anyway. And what if you collected a dollar premium on the way in? So if you're selling a put, you're collecting a premium. And let's say you collect a $1 premium times 100, that'd be $100. If you're put the shares at 35 and you collected a dollar premium by selling the put, if the shares are put to you at 35, you're forced to buy them at 35, but you're collecting a put premium. So then effectively your basis might be 34 or 34.50. If you collected 50 cents, your basis would be 34.50. Okay. And you can kind of do the math on effectively reducing your basis by selling puts. Okay. So this is known as what's called a credit trade because you're selling a put, you're collecting a premium, and you're selling someone else the right to put shares to you. Okay. And they'd only put shares to you if it finishes below 35 strike in this case. Now, I'm going to pause just for a second. And, there is a quick question about anchor and offset. So anchor in this case would be the option that you sold. Okay. And the offset would be, in this case, the insurance. Okay. But I don't want to get ahead of myself. So just for right now, the anchor would be what we affectionately call like the money maker in this transaction. Okay, so before we get into anchor and offset, anchor is kind of in this case, the option that we're selling. Okay. Just the concept about selling a put. Is there any quick question about what I just shared about selling puts? Don't be bashful in your questions. Now's the time to make comments or questions. Don't be bashful. Well, let me back up. Did what I share make sense? Selling a put where you're willing to own. Did that concept make sense on the single leg side? I'll shut up for a second. Jennifer's happy. Okay. Not know nothing? No comments from the crew? Okay. Herman, making sense? Jennifer's heard, yes, but yep. I think I should say 35 strike or 30 strike. Yes. So I have another slide to share in just a moment, Brenda. So hold the phone on that. This is just foundation. So this slide, yes, there's a lot of things missing to this slide, but I lay this out to people, newer spread traders, and I usually write this on a napkin or a piece of paper if I'm physically one-on-one working with someone. And then all of a sudden you see the light bulbs come on. Okay, and Daniel's good. Okay, cool. And so, yes, Brenda, absolutely, there's things missing on this slide. We're just kind of building our foundation. So this is kind of no, this isn't even pouring concrete yet. We're grading the dirt right now in our foundation. Okay, so before we move on, I do want to explain the next step here. So instead of selling puts, I could also, in addition to the moment I'm selling a put, I can also buy a put. And this would be the 35 strike to be fair, and this would be the 30 strike. And they call this a 5-wide spread in this case. Okay. Now, why am I doing this? Well, what if you're bullish on the ticker? You really don't have a desire to have shares put to you, and you don't want to fork over or reserve $3,500 in the account just to sell a put. What if I were to tell you you can sell the 35 put in this case and then buy the 30 put? And this would be known as what's called a defined risk trade. In this case, the maximum you could lose is $5 a share. But the kicker is you'll collect a premium selling a put. So you sell a put, you collect a premium, you buy a put, you pay a premium, and then there's going to be left over what they call a net credit. Okay. And so then let's say you're bringing a net credit. Let's just use $1 to keep math simple. So what if I sell a put for $2? I buy a put for $1. I receive a net credit of $1 premium, or $100 per spread, basically. And if it doesn't dip below, if it stays above 35, this option is going to expire worthless, and you keep the $100. Okay. And it's known as what's called a defined risk trade. And the premise being is that it also reduces maintenance, and it's also insured. Okay, so it's defined risk and it's also insured. So that's what the offset is. So the anchor would be the driving force or the moneymaker. The offset, sometimes people reference, as what they call insurance. Okay, and you heard me say I have friends that have done cool things, and one of those friends was a Chicago pit trader that handled the SPX orders on the Chicago floor, and he more often than not took orders from Goldman Sachs. And anytime Goldman Sachs brought him a trade, it was always a spread, and it was always a credit trade. Okay. Now let's for a moment, let's move on to the next slide. Okay, so I'm going to move on to this next slide. And this is trying to put more pieces together for all of you. Okay, to where, and we'll talk about the calls in just a second here, but let's take more pieces together here. So this was US Steel, and I did this screenshot shoot probably 4 months ago, I want to say, maybe 5 months ago. And so here is US Steel, and you can see at the time it's roughly kicking around, let's say $28 a share. We're just using loose math. Okay. And what if it were trading at 28? I could identify a major pivot, and that's what this is. So price was coming down a little bit. We got these bottoming wicks, and then price took off. Okay. And so I labeled it as a pivot, and sometimes they call it a pivot. Sometimes they call it a price capitulation, which is another fun word. All we know is prices were dropping, they stopped, and then went back up. Okay. Now, what's interesting about credit trading, okay, and if you want to start diving into a little bit more my personality or where I've evolved in the past 20 years or 10 years or whatever it may be, to how I trade and how I trade options specifically, I enjoy selling options. I enjoy selling credit spreads where price won't go. Okay, and that's a kicker. And some of you that are taking notes, you might write that one down. So Sean enjoys selling credit spreads or credit single leg if it's a retirement account. I do sometimes single leg credit, like in an account that I may have larger assets where I don't mind owning the shares. But for like weekly income, I enjoy spread trading, and I enjoy selling options or selling credit spreads out of the money where price won't go. So for those of you that have traded stocks, so for those of you that have traded futures or Forex currency, you have to be right. So you jump in and you're trading very directionally, and you have to be right. So in order to get paid on those transactions, it has to move in the direction that you need to. Okay. This is a little different. And I remember time and place. This is as nerdy and geeky as it sounds. I remember time and place on this. I remember where I was sitting. I remember what time of the day it was, where the light bulb came on for me. I'm like, oh my gosh, I can structure a trade instead of having to guess where price will go. I just have to guess where price just has to avoid. Or what I like to say, you place trades where price is less likely to go or price won't go. Okay, there's no guarantees in life, but we can kind of structure our trades that way. And so that's kind of what you're staring at the screen right now. So let's say that the stock is trading at 28. I could sell a put at the 24 strike right now and collect a 75-cent premium. Okay, or $75. At the same time, I could buy a put at the 22 strike and pay 45 cents. So I'm bringing in a net credit or net premium of 30 cents or 30 bucks on a $28 stock. And this would be for one spread or one contract. So I'm selling one put and then buying one put. And it's giving me a net credit of, 30 bucks in this case. And this is affectionately known as what's called a two wide. And it says the risk here is $2, but it actually is less than that, because the difference between the strike prices is two points, but you're bringing in a 30-cent premium. Okay. So then the max risk profile is 170 bucks per spread. So if this thing just goes to, blows up on you, it's known as what's called a defined risk trade. In this case, would be 170 bucks. So if this thing keeps dropping, guess what? Your insurance kicks in below 22. Okay. So let me just take an uncomfortable pause for just a moment. How are we doing so far? There's going to be 3 or 4 more layers that I'm going to share, and I'll get into a trade that we did this week in our session. But talk to me, group. I'm going to pause for a second here. How are we doing so far? What is a major put? It's not a major put, it's a major pivot. And I can give you the teaser. I can share. I can share. This is a trade I'm going to review in just a moment with all of you, and this is a trade we did in our session this week. But a major pivot. So not a major put, but a major pivot. Okay. And all that means is price was just tearing down. It stopped and went the other direction. So when someone says pivot, and why do I say, and let me give you more context. So what's the difference between a major pivot and a minor pivot, Sean? Hold me down to the fire, right? Well, if you go down to like a 5-minute chart, we can go down to 1 minute, right? The pivots we see on like a 5-minute chart, we're not going to put that much weight on, if that makes sense. So the bigger time frame that you pull pivots from, the more substantial the pivot may be. So like I'm on a weekly chart here. The fact that this price was dropping, it stopped and then went back up, right? Guess what? is it doing the same darn thing? And sure enough, did this pivot respect this pivot? And so for whatever reason, this is Schwab, the ticker Schwab, it likes 45 bucks. So is this pivot, or is this major pivot, as we'd call it, still something to take note of, noticeable? Okay. And so that's what we mean by pivot, where price is coming down, 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 stopping, and then kind of reversing direction, if I didn't make that clear. And we put more weight or weighting on a bigger time frame pivot, you know, because if you look at like a 5 minute or look at like a 1 minute, you know, let's find a 1 minute pivot that it violated. Yeah, here'd be an example. And this was today's action. Price came down, stopped, went back up, but then guess what? It ended up violating or going lower than this pivot. And it went to this lower level. So is this the major pivot? I'm not even going to call this a major pivot. Yes, price did go back up, but I'm going to lean on bigger timeframes. And we work with our students in my sessions to where we use weekly for trend and daily for strike and pivot selection. Okay. If that makes any sense. Okay. So, it can be a pullback, Brenda, but more often than not, it's like a pivot where price changes direction. And I mentioned that we use daily charts, right, in our sessions for strike selection and or um, for strike selection and or I just drew a blank. Strike selection and or pivots, right? So here's the daily chart, and we can see that price came down, stopped, and went back up. Now, sometimes price will come down and we get these stair steps, which is another conversation. So at first glance, you could say pullback, but a pullback would be, let me find you an example, would be kind of this. So price went up, it paused, and then shot up again. So a pullback could be this here. And so was this some sort of pivot, right, off of this action? So price went up, it paused, and then it shot up from here. And, you know, sometimes people like the expression price has memory. That's kind of a fun one. And so price shot up from this area. Guess what? Price drizzled back down again, and it pivoted right here and went back up. So could you call this at the time, was this a major pivot? Could you have bought here or bought here and done okay? Eventually, was the level violated? Okay, but that's a bigger conversation, getting into more just technical analysis and approach. And I'm a big advocate of the more times it touches a level or a price point, the less we like it. Okay, so you think of a bouncy ball, where you bounce a bouncy ball, each subsequent bounce can be less and less and less. Okay. And so hopefully that makes sense. Hopefully I'm not oversharing, Brenda. Let me know if you have any follow-on questions. Okay. And so let's go back here and going back to this slide to where major pivot, all that means is price was coming down, down, down. It stopped and then went back up. Okay. And so at the time when it was trading at 28, could we have sold a 24 put, bought a 22 put, and got a net credit here? And basically all price needs to do is just avoid this area. And, you know, could it slide down for 3 weeks? Absolutely. But if it doesn't become in the money, then it's going to expire worthless and you keep the full 30 bucks. Could this thing just go sideways? So this is different. Doing a credit trade, we can get paid by time passing. So the more time that passes, you know, let's say there's 30 days left in this trade, the more time passes, the less likely it's going to get down here. So they start to price into the premium and the premium starts to erode, which is causing us to generate revenue. And so either time passing or just avoiding our strike selection allows us to generate revenue when you're a credit spread trader. Okay, now a couple more pieces into kind of the bigger picture stuff. Okay, so there are things we look at in our class. Okay, so I don't know if you heard me mention them before, but we look at what's called volatility. So I can drag down one of my watch lists. I'm trying to think. Here, I'll just drag this one down. Okay, so I don't know if anybody can see this, but this is just a watch list. And this format has been the same for me for probably 10 years, but it's probably closer to 15 years. To where I have the ticker, I have the last trade price, I have net change per dollar amount. I don't look at net change percentage, I look at net change per dollar amount. ATR, which just means the maximum wiggle per day on average over the past 14 days. And then implied volatility. And so implied volatility is, I don't want to get too deep into implied volatility, but it's like a heartbeat. You know, my heartbeat range is probably 40, 50 beats per minute to 120 beats per minute or 130 beats per minute, depending on how good a shape I am at the moment. I'm kind of middle. I'm not the best shape, but I'm not the worst shape right now, as far as my physical shape, right? And so what is this measuring? Well, it's measuring the heartbeat of your stock, and it's measuring the basically yield on premium over an annual range. And these percentages tell you, is the yield on premium closer to the upper end of the scale or in the lower end of the scale? And so if we're a credit trader, if we enjoy selling options, we like to sell options on tickers that have a little bit juicier or a faster heartbeat right now, or the yields on premiums are more advantageous or juicier than they have been in the past. And that means we can collect more premium or more yield when we sell options. So between tickers, if I scroll down, tickers that are 40% or lower have a lower heartbeat. So if we sold options on these tickers down here, we'll get a lower yield. Okay. And we probably want to avoid them. Now, if you're an option buyer, you enjoy buying calls or buying puts, you may be picking candidates from down here. And you wait till it's in a level or in a zone and then do a debit trade. You buy options with lower volatility. And yes, they may have lower volatility right now, but if they're in a zone, you expect them to get more exciting later. So you step in when they're boring and then you get out when they're exciting. Okay. It's the reverse for credit style trading. So for credit trading, we like tickers that have faster heartbeats. We like tickers that have faster heartbeats because we can get bigger yields on our premiums. And then we get in when they're exciting and we get out when they get boring, because then the premiums erode and we can get out. Okay. So I don't want to get too deep with implied volatility, but this is just one of the filter criterias. So to pick direction and candidates, we look at trend on a weekly chart. We look at implied volatility. If it's got a faster heartbeat or slower heartbeat right now, then we need to go to the option chain and start shopping for premium. Okay. Now that's kind of in a nutshell, like the ingredients that we look for. So we look at trend, we look at implied volatility, and that tells us whether to do a call credit spread or a put credit spread. Okay. Then we want to determine, is this a juicy premium or not? So there's actually a way to determine, is this a good premium or not? And this is where I delineate from pretty much most of the option books out there. So one thing unique to me is I like to time Vega. And hence that's the name of my weekly course or weekly sessions is Vega. And what that means is that we're being picky when we jump in. So not only do we look at trend, we look at the implied volatility, we look at the strike selections of the spreads that we're going to do. Then we get down with a fine-tooth comb and we're picky with our premium. So that's one big difference with me, is that I'm very picky when I jump in. So let's say I determine that we can look at this example here. We determine that, you know, this thing is having a bad day. So we are very cognizant if our tickers are having good days or bad days. And if the stock is having a bad day, we'll get juicier put premiums and put on the trade. And I might add, we oftentimes can go further out of the money if we're simply waiting for up days versus down days on our tickers. So the ism that I share with my group is we like finding uptrending stocks with good implied volatility having a bad day. Uptrending stocks with good volatility having a bad day, because then we can get juicier premiums. And so if we were to sell like a put credit spread because we're bullish, right? Going back to this slide, a put credit spread is bullish. So if we find an uptrending stock, and I kind of drew it here, having a little bit of a bad day, we'll get juicier put premiums on the put credit spread. Now, that's a delineation from most of the books out there, because most of the option books say you pull up an option chain, you find an acceptable yield, and you jump in. But who's to say if that premium that you're jumping in on is the worst premium that spread is offered all week? So I work with my students how to chart premium, how to analyze premium, and determine, is this a good premium for this specific spread right now? And so instead of putting on the trade right then and there, we may offer out. And that just means that we're going to be asking for a different premium for that same exact spread. And we're okay if it fills 2 days from now. Because yes, it may fill on Tuesday of next week, but we're going to get a juicier premium. And then we may only be in the thing for 2, 3, 4 days, 5 days, and then get out once we get a profit target on our premium. Now, the only people that I've come across that I am like-minded with, because again, I haven't come across this in an option book. So option books will talk about trend. Option books will talk about, the implied volatility, like I've shared here, right? But they won't talk about, is this specific spread, is it time to jump into this spread right now? So the only people that I've come across that are like-minded are the ex-Chicago pit traders, because I've shared some of this, and I've met and I've known, I don't know, probably half a dozen, maybe more, ex-Chicago option pit traders and on the exchange, and their expression is, it's all about the Vega, Sean. It's all about the Vega. They're going to sit there and crunch the option Greeks. I'm more visual, and if you want, I can show you what charting premium looks like before we wrap. But that's what it's all about. So they're very picky on the premiums when they're jumping in, because again, option books, I know most of them out there say you pull up the option chain, you find an acceptable yield right now, and you jump in. Okay. But more often than not, I don't know if any of you have ever sold an option in this room where you sold an option, and the moment you sold the option, it went against you, and you had to sit in the thing for 3 weeks before time decay or theta decay finally forgave you for a terrible entry. And it's because you got in, probably, like, for instance, you sold a put on a stock you wanted to own, but you sold a put when the stock was up 3% that day. And you got the crummiest put premium that it's been in the past 2 weeks, and the stock retraced and the put premium went against you, and you had to sit in the thing for weeks before it finally forgave the terrible entry that you did. And so this is something not written about in books. I haven't come across it, but it's more so, being picky with your stock, identifying trend, finding your strike selections, then picking the option, then being picky with your premium. So yes, there's several steps, but once people discover this, it can overflow into your debit trading. It can overflow into your credit trading, whether that's single leg or a spread. And it's just timing volatility or timing your premium from multiple capacities. So hopefully that makes sense. And let's keep going. Someone's commenting, confused about something that I hope you can help me with. If you are buying and selling puts to do directional trades instead of spreads, it can be out to you. It can be put to you. Okay, yeah, it can be put to you. Yeah. So this actually happened to my nephew very recently. He did a put credit spread, and it was weird and wacky. He did a put credit spread, and the broker decided to put some shares to him because the spread became in the money, and he ended up being put the shares, which was strange. They kept the part of the debit, the full debit. So I think he did 10 contracts, to make a long story short, and they put 400 shares to him, but they kept the full 10 contract debit running. So he ended up with, I want to say, 10 debit and 6 credit. Did I say it right? Something like that. And what was surprising is that the money involved cashing out of the debit was pretty substantial. So it became in the money, and the debit leg was offsetting the pain. But it was fascinating how much profit we had from the debit leg. So they closed out of the short leg only 4 contracts of the 10 that he had. So are there nuances that can happen? The answer is yes. So that's why it's key to manage your risk, and it's key to understand these things. And once you've been trading, I mean, I've been doing options for 20 years. So it's like, once you understand all the things that could happen, then you go about your business. And people love to point out the outliers. I think I've been assigned shares. Now, it's also to do with my style of trading. I'm an out of the money trader, but I think I've only been assigned like 3 times in the past 20 years. But again, I'm doing more, away from current price type stuff, but it's rare. And even my nephew being assigned shares, the broker's supposed to randomly choose which client that they're going to do that to. So the statistics of it actually happening are rare, especially if you're doing out of the money. Okay, so that's a little bit of a rabbit hole, but are there things that can happen with a spread? Sure. And you just know that going into it, and all the things that could possibly happen. If you go outside the house and you think there may be, storm clouds, you take an umbrella, or you wear rain boots because you think it may be wet today or maybe muddy. So you just kind of know what could happen, and you just prepare accordingly. Okay. But yes, could you be assigned shares? Yes, you could. But normally you can structure the trade where it's far enough out of the money so that doesn't happen, as a statistical probability, or you reduce the, not quite to 0, but you can substantially reduce the statistical probability of that happening the way you structure your spread. Food for thought, right? And Jennifer's pointing out that, you still kind of can establish the max risk. I'm losing my voice for some reason. Hang on. Hello, can you hear me now? It's a little better. Went to the country fair last night, right? So maybe this is because of it. It was mostly grass, but then they had a huge section of hay and dirt. Anyway, that's probably aftermath of the fair last night, walking around in the grassy fields. Anyway, so hopefully that makes sense. And what if you are assigned shares? What if shares are put to you? And in my nephew's case, they assigned shares early, which was strange. What if you are assigned shares? Could you keep those shares? Yes. Could you sell those shares very quickly? Sure. So there's different things you can do in the way that you plan your life or structure your life. Okay, so hopefully that makes sense. All right, so let me keep going, and we'll talk about it here. So hopefully we're okay here, and we can come back to the calls. I do have a hard stop at 10, so I think our session was an hour. So just know that I got 5 minutes, so I'll make it quick. So let's back out to the trade I was showing you. And so this was a trade that we did this week, maybe to put more context behind some of this. And so this was a Schwab trade. And I am a guy that likes to take advantage of things, having a bad day. And on the weekly chart, we can see what Schwab has done. On the weekly chart, almost 3 weeks ago, Schwab popped above its moving average. It was a downward death spiral. And we had these bottoming wicks, which is creating a floor foundation or major pivot, as we called it. Then we saw it pop above. And so then I was like, okay, so we might be biased towards being bullish on Schwab. And we talk about the implied volatility. The implied volatility on Schwab is, let's look here. The implied volatility on Schwab is 40% right now. So it's a little bit light on the implied volatility. During this down period, it was spiking 55, 60, 65% implied volatility during this run. And so it's kind of getting back to being boring again, if that makes sense. But this week we had a little setup. Schwab had a bad day. Schwab had a bad day here. Our entry was 612. Schwab had a bad day, and during that time period, we went ahead and put on a trade. We sold the 4750s, bought the 4250s, and did a 5-wide put credit spread. And we can put our cursor where I put on a trade. We put a trade down here. So again, we talked about doing a spread trade or doing a credit where price won't go or less likely to go. And if I scoot back, that shoved, hang on a second, that shoved, right down to this level. Is this a major pivot? And we sold a put credit spread kind of at this major pivot. Look how many pivots it's down below. We were able to get 50 cents a premium on a $50 stock net on the spread. And needless to say, we kept the trade running today, but yesterday, I think the premiums eroded down to like 20 cents. So we got a 50% or more, and that's usually a target that I work with my students on. We might bounce and get out of the spread once we have a 50% decline in our premium. And it happened in a couple days in this case. So Schwab was having a bad day. We were able to do a put credit spread at the 4750, 4250s and bring in a credit of about 50 cents, which was kind of fun. And, by many people's standards, we met a profit target to where, it popped up this morning and pretty good premium crush this morning. Okay. So hopefully this is making sense, but we're cognizant when we jump into our spreads. Okay. And it looks like I'm a little bit short on time, but also chart our premium. We can chart our premium and to look at the premium range of this specific spread over the past week or so. And so we were able to capitalize the fact that it had a bad day. We got a decent premium and then it recovered, right, and went back up, and then we were able to cash out or, hit our profit target. Okay. All right. Looks like I have time for one quick question. Can it be put to you? If you're doing debit, it can't be put to you. You have a right and obligation, Helen. So if I bought a call, they're not going to assign, or if I bought a put or bought a call, they're not going to assign shares to you. It's a right, not an obligation. If you sell options, it could become an obligation. Hopefully that makes sense. All right, so I'm bumping up against 10 o'clock. So I told you I had a hard stop, so I better take off. So hopefully all of you enjoyed this. I don't mean to be rude and jump off, but I got another commitment. So hopefully this was fun, enjoyable. Hopefully some of you learned some things as well. And I'm happy to, meet and greet and do an introduction, and then you guys get a face to voice to all that kind of good stuff. So cheers, happy trading. I love that expression, and we'll catch you next time. Take care, everyone. And yeah, let the powers be. If you enjoyed this little session, let them know. Take care, everyone. Bye now.